Welcome everyone to the Kendall Report. It is Tuesday night and we had quite the day. It seems that all I have to do is mention a number and the markets go there. So I mentioned going to 3780. We went basically to 3780 and I have a lot to talk to you about tonight because I think we're going to see a pretty big rejection from these levels. It's going to be a pivotal day, so I'll talk about that in the details. Before I get into tonight's video, make sure you subscribe, hit that like button, and hit the notification bell so you'll know when I come live. So a couple things that were evident, I thought, today is that it was massive short covering. I talked about last night when the VIX gets 31 plus, you probably should buy. Well, that was certainly the case, right? S&P up 2.45, Nasdaq up 2.51, Russell up 1.71. Year to date, though, S&P still down 20.7, Nasdaq down 29.9, and the Russell down 24.3. So it felt good, but really wasn't. Energy bounced back. I talked about that last night. Thought we could get a bounce back. We did. I can tell you, I will go through the details here when we go through the database, but the energy sector looks like it's rolled over. I thought it was interesting. Everybody, I love watching that halftime report because you can get a feel for exactly what not to do. Just fade those guys. To a person on that show, everybody is, oh, the energy trade's not over. I'm telling you it's over. We've moved to, on our ETF hack, we've moved to 27%. I love these kind of openings when we get a bunch of sells. You get a higher opening, you get to sell into strength. It's an awesome way to go out of a trade, especially one that's worked so well this year. So basically, I'm telling you the energy is probably over. We're likely to get an exit on our sector. I'll show you that in just a minute. And there's just a ton going on. And I'll go through this. I'll talk about a few details before I get into the actual charts. But, I talked about housing coming apart, right? Existing homes down minus 3.4%, sales down 8.6 year over year. This is just, this is the beginning, folks. This is just the beginning. We're going to see some more numbers come out over the next couple of days. On Friday, I believe we've got new home sales. That's going to even be worse. Everything's going bad. The one other thing that I want to talk about is, I guess economics. We have mortgage apps coming out tomorrow. I doubt if that looks good. I'd be surprised with rates spiking like they did. But the big event tomorrow is going to be Mr. Powell. He's going to be speaking in front of the Senate Banking Committee. It's his annual presentations. I think they used to, I forget they called it Sadie. It wasn't Sadie Hawkins. It was something like that. But they used to call it that. It's now just his annual report that he's doing. And I think he's going to dance around talking about a recession, soft landing. What he's trying to do is get everybody ready for this next event. And they know what's coming. And I think, we've got another Fed meeting, I believe, coming in July. I said August last night, and I believe it's July. We're probably going to see another 0.75. They can't back off of this thing. They already have no credibility. But tomorrow's speech, Powell, the Augos are going to be picking up just about, anything that they're saying. It's just going to be, basically, it's just going to be more of the same rhetoric, but markets are going to be reading into everything. And, I'll go into more detail when we get into the energy, but I think this thing is rolling over for the moment, and it's rolling over for one reason, is that there is a massive recession, maybe something worse coming. I don't see anything ending good here. Saw somebody mention in the comments, which I'll talk about as well, Japanese yen 136. I think it was 136.50. It's Dow yen's down a little bit right now. I'll cover that. And I also want to show you the JGB. So save everything I have to talk to you about when we get into that section. So stay tuned in here. So just looking at my notes here, the 10-year rebounded, yield curve steepened. So we're no longer inverted. That happened today. And I already mentioned this note, it was that the energy sector looks like it's rolling over. So let's go ahead and get in the database and get into the main part of tonight's presentation. Okay, as we look at the database, we had 279 buys, 124 sells, no big deal, in spite of the 2.5% increase, pretty much across the board. We'll call it a 2+%. Database at 12.78. Yesterday, it was at 12.62. So there's not a lot difference there, just a very small bid. It's showing up on the 3-2 as a bullish because the ratio is pretty good, 212 by 33, but it's not really, I guess the best way to put it, it's not really that bullish because it's such a small number, especially when you look at the contrast of over 16,000 symbols in the database. So we're only 2,065 long. So I said I'd talk a little bit about this. So I'm going to go over here and go to the weekly models here. And I've been talking about this energy trade that's been on for a while. It's been on for 392 trading days. It normally holds 338, so we've extended. It's given back a lot on the index. So let's just take a quick look at what this index looks like, and I'll show you what I'm talking about. We have just plummeted. We're cut through 10, 21 period moving average. PPMs have all rolled over on a weekly basis. This is our internal index that we build. This is not a good sign. We're looking at everything rolling over and going negative, especially PPM1 has actually turned negative. So there's going to be a ton of resistance. If there is a rally back any further, there'll be a lot there. But this is going to roll over, which will mean, if you look at this page that I have up right now, the only sector that was long was energy. We did have transportation on. It failed. We exited on this morning. We got out of the index of the transports. So all that's left is energy. So this is the realities of where we are in this scenario. We're about to enter. We've got a 7.46 bullish rate overall. There's only 1,200 symbols out of 16,000 that have a current buy signal, which tells us there's virtually nothing moving to the upside. We've got one last sector left. It's going to be gone. Unless some spectacular rally would have to happen to keep that index from selling out. So we're going to have 0 sectors long. And this was the thing, I talked about this a few weeks ago, is that energy sector was the only one that hadn't been hit. Well, it's been hit, got hit in a big way. Doesn't surprise me. There's still a lot of folks thinking just like they were on, buy back the energies. And I think that's kind of the mentality. That's what sentiment does. That people are buying the dips. You probably get a rally back, and then it will get maybe a right shoulder, and then it will fail, and it will capture the rest of your money if you didn't get out recently. That's what will happen. And that's the way it usually works. So he sets up the right shoulder, and then there's another leg down. And what, to me, think about what this market would have looked like if during the last several months that energy was declining. Well, you're about to find that out. And energy could be the leader on the downside now as they unravel that. And it just, everybody's been bullish on this thing. The last week's activity in energy stocks should have told you a lot about what's going on. So be careful trying to get cute. There might be a little bit of a rebound, but what I see happening is the database going to 0 sectors long. And if we look at the groups right now, there's only 5 groups. I usually don't bring this sheet up, but if I come up here, there's only a few groups. Oil and gas operations is one that is out there, and the rest, footwear, that's not working. Communication services, these are the last 5 groups. And I have to tell you, this is historic here from my perspective, from Wavetech. This platform's been around for 20 plus years, actually since 1996, technically. And the reality is that this is the second lowest number I've seen on the database since the spring, probably February of 2009. So this is how bad things are right now. They're so bad that we own nothing. And I can tell you, when we moved to that level, there was still another leg down. It was actually probably just after Lehman. I was trying to look up, see if I could find when that number was printing, but it was after Lehman failed, coming into year end back in 2008, coming into early 09. We bottomed around April when things got so bad. You have to remember, I just want to go into a little bit of a dialogue here, because you have to remember in 2008, they were doing TARP, they were adding money, QE was beginning. And now, where are we? Let's do a contrast. Let's look to where we were then, and then look where we are now. Where are we now? We've got massive inflation. Maybe it's going to moderate, because maybe oil and some of these things will roll over, but they're only going to moderate to a point. But here's the big deal: is the Fed needs to downsize the balance sheet. They have to continue to raise rates at some level, whether they get the Fed funds to 3.5%, 4.5%, should be probably 7 or 8 or higher. I've said this before. So we are in such a different position. The Fed's not going to all of a sudden print money and start QE all over again. And I'll talk about the Japanese here in a few minutes, but they've gone nuclear to save themselves right now. And it's going to get incredibly interesting. I'll save that talk when I get there to cover that. So let's go ahead and get into the technicals tonight so we can get through the rest of the details. Okay, first market we'll cover is the S&P. We're down 20 handles already, down 0.5%. I talked about that 10 period moving average and the PPMs where they were yesterday. I thought it might take us 2 days to get up there. I said a 2 or 3 day rally. Well, it's always one. So just remember, folks, you watching this channel, when I talk about numbers, I usually say, well, it should take 2 to 3 days. It's probably going to go right that day. So let's look at the numbers. Yesterday, we got up to 83.75. The 10 period moving average, which is down 0.97, by the way. We'll talk a little bit more about that here in a second. But that number was a point where we get rejected. I even said if we did print over 38, look for a rejection. I thought we'd get a couple days. I don't think we're going to get that. The number today, because of this sharp decline in that angle of attack on the downside, we're now at 0.97. PPM2 is 0.23. It's trying to get through its first and second derivative. PPM3 at the next to the bottom one where I have my cursor here right now, that is turned back down, did not penetrate its first derivative actually. So we're right at that point where we're going to find out whether there's a leg on the downside. So this is really critical because everybody, you get these one-day wonders, and that may be what we're dealing with here. It's going to be interesting to see what happens. If we can hold around for another day, stay below the 10, not do any serious damage on the outside. Well, I'm going to bring up the market grid for today, just so you can see what that is about. Market grid for today, the 10 period moving average, 37.78. 37.88 is R1. We've had a high of 37.67, so we could test that. We could see a bit of a rally and test that R1 level. 37.88, 37.78 is the 10 period moving average. Like I said, down 0.97. That's a big number. There's only about a 20% probability that we would close above 37.78 tomorrow based on that PPM value. That angle of attack is substantial. So what we're going to be looking at is on the downside, right now we've printed 44, which is S1. So look for the potential of S2. If we take out S2, you're going to challenge, there's going to be nothing stopping a 37 handle being challenged. And you can see STX is 36.81. That would be pretty damaging. So just to come back a little bit and pull back some of the ideas there from that standpoint, we're at that inflection point where that 10 period moving average is. We'll see if we can get a rejection. If we hold the market grid tomorrow and maybe stabilize the next day, then we could see this downward pressure start to bleed off. But this is a very dangerous point, and I'm going to draw in on the chart what the possibilities are here, and it gets pretty ugly. Those of you been in the live room, and you'll know this is that 1, 2, 3 pattern I talk about, and it's very dangerous at this point in time. So let me draw this in so you can see this. I'll go full screen so you can see what I'm going to draw. So this would be the pattern here. This is one. We could, what I was talking about is maybe if we got through this, we would probably come at worst case, come up to the 39 handle or so, something like that. That would be the worst thing. That's 200 points up. I don't see that happening with this 10 period moving average. So I'm going to erase this. So the possibilities are for us to get a move like this, where this 1, 3, we start to look at the possibilities of coming down to these fib targets. And I mentioned these the other night, even though they're not currently calculating, that pattern is still valid. And I'm going to draw in a couple more things. This configuration actually flows through all of the indexes in general. So I'll say something if we go through the review, if I see anything that is contrary to what I'm showing you right now. But these are the target zones here. So let me clear this out again. Let me just take this off just so we can get these numbers. So those numbers, low target 1, 34.43, 31.93, and 30.38. So I'm not saying that's going there tomorrow, but this 34 number is real, and we could find ourselves just failing. Who knows what comes out of Powell's mouth tomorrow? So let's go to the weekly chart just for a second so we can get some contrast there with that as well. Weekly's turning up, but we still have these massive negative numbers, 1.57, 0.75. I talked about these numbers. If you got up to 4,003, that would be the ultimate sell. We're not going to get that. And in fact, probably right now we're going down 60 handles per week. So that'll be 39. In 2 weeks will be around the mid 38. So that's still a possibility if we hold some support numbers in here. But just be aware of these numbers and watch out if that 37 handle gets taken out. That's going to be your sign. That's the uh-oh sign. Something bad has happened. So taking a look at the Nasdaq next, like I said, these patterns are flowing all the way through. The Nasdaq, however, has clearer patterns out there. So we have a couple things to look at. We have this is the weekly that we're on. The weekly 200 is in play here at 10,831. We also have 2 Fibonacci targets below 10,164 and 9,200 is in this pattern. And these are big numbers, folks. 1.92, 1.04, 0.66. So if you're new to the channel, these numbers mean that there's less than a 10% probability of getting above the 10 period moving average. Now that's way out of play right now. Like I said, it's up here at 12,324. So it's 1,000 points away. But the point is that these numbers are coming down, and when you're within these trends, and I've shown you a lot of times this angle of attack theory, and the angle of attack is big. This is not where this pattern ends. We could see some consolidation. And I won't go through the scenario there until I see the reason to talk about it. But this is a very longer term pattern. And I saw, I saw something today, and I meant to screen cap this. And I totally forgot to do this. But it was, I want to say, it was like 50 reasons why the market's going to finish higher this year. They actually said that. I guess it's good for America if that happens. I don't see that happening. Not coming into recession, not going through the scenario that I'm talking about here with our database, actually going to 0 sectors long. What's going to drive this thing? And if I went through sector by sector and showed you the technicals by sector, it's a disaster. We're a long ways. We're 6, 8, 10 weeks if we stabilized here from setting up any type of pattern that would ultimately reconcile itself into some kind of an uptrend. It would take months. So We are, and I did talk about this last night, and as we're getting closer to that trigger point. Remember the 45-30 number I said I'd be focused on was not even in play right here, right? We're on basis the S&P. None of these numbers on a quarterly basis are in play. We're going to get confirmation, but there is probably about I'm going to call it close to a 60% probability once we get through June that we will, as we come into Q3, we might see some stability and some movement up. But this may be, we could have the final blow off just right here at the end of June. And then that would be the capitulation point where the market printed down. And then basically that's where you get the buy from. Everybody's talking about whenever you see these days, it's a tradable bottom. Well, they did that last week, but week before last when there was a little bit of rally, this is a tradable low. And then, then you see a new low, and then you get all of this stuff that we get is just going to continue. So just know that we are a long way structurally, and I teach about this in our live room, and I talk about this from time to time on the channel, as structurally, we are a long ways from setting up something that is a sustainable bottom. From the database percentage bullish, from the patterns that I'm seeing on all the indexes when I go through them, all of that stuff is just not there. And could we rally and bounce? Sure. Are we going to get a sustainable rally? Very unlikely from this position. Maybe in hindsight, you look back and go, oh, that was the low, that last low we had. That's fine. But structurally, I always talk about before you can make moves in the markets, you should have some structure around them. And based on that, basically you want to keep kind of I don't know if you folks have heard this analogy, but you date your trades and marry your strategy. So this is just going to be a date, maybe a one-nighter. It's going to be, you take it out and you're just going to get what you can, take the money and run on these patterns, and that's it. Because if you get too in depth in thinking there's something more real here, you're going to be disappointed. That's my point. So the Russell is next. As we look at the Russell, sorry about that. We look at the Russell, the PPMs are just, this is the daily, big numbers, 1.10. We're just not likely to get anything to the downside. So this, to the upside from here in a significant way. We could move back into moving averages, 1803. Let me bring up the RTY so we can at least see how the futures are trading. They're negative right now by 0.6. So we're looking at some downside here. PPMs are stable, but they're huge negative numbers, 1.18 and 0.21, 0.27, basically trend mode across the board. The 10-period moving average is going to be in play the next couple of days. So I don't expect to see anything massive come out of here. The most you could expect, I'll just come up here for a second. The most that you could expect out of any of these patterns is a move back toward the 21 and 40 period moving averages. They're almost at the same. We do have a little bit of contraction of volatility on the market grid. That sometimes will indicate that we've got some kind of shift going into markets. But right now, I'm just not seeing it from the standpoint of where the database is and everything that I've been talking about so far. Let's go over and just take a quick look at the weekly studies, and same pattern. We do have some Fibonacci targets on the downside, and what we're looking at here is those numbers are at 1577, 1481. So there's some pretty big numbers. This is the weekly RTY we're looking at, and PPMs once again off the map on a downtrend. Next, we'll look at the 10-year. I don't know why I keep doing that. Apologize. Looking at the 10-year, what we're seeing here is riding above that 10-day moving average. I went through a lot of detail in last night's video about that. We're just writing that number. We look at that 3.02 yesterday. Yesterday was 3.20. The low was 3.197, so basically 20. And then we got a little bit of a bounce here. PPMs are trying to turn back up. And I tell you what I think we're setting up, because I'm going to cover the yen next. And I think I'll be able to show you, I think there's a potential another round of selling in the treasuries coming in. And I think it'll be our friends over in Japan. And we'll talk about that here in just a minute. So that is the big numbers. So let's go over to the weekly for a second here. We'll take a quick look at the yield curve, then we'll go. There's a couple things I want to talk about basis the yen. Yeah, Kate, I usually don't answer questions during this. The reason why TV market grid is sometimes different is because they're different databases. The database that TradeStation has and TV are different. The database that we maintain in our software is different. All databases have some variances. And once you get into data, not all data is equal, and there's no way to do it because everybody's got different times where they're doing stuff, and you just don't know the integrity. So TradeStation definitely has, there is some differences, and whether it's TradingView or not, I don't know. I would just put that out there. Somebody else had written an email in talking about that. So let's take a look at the weekly numbers, and the 10-period moving average here is on the at 3%. Talked about this. We should remain above 3, probably 310. I don't see us getting much below that. I think we set up some kind of potential sideways, but if what I'm going to show you next on the yen, if this thing triggers, I think you're going to see something pretty substantial come out. Let's take a quick look at the yield curve. You'll see yield curve steepen, 530s at plus 0.1, one tick. One tick is a tick. It's not inverted. The 1030s that I talked about last night, they are at 0.83 now. So there was a fairly big increase just in one day. If we go back to this, we were at 0.55, now we're at 0.83, and it was just a few days ago we were actually negative by 5. So the yield curve is continuing to steepen here, which that's a good thing. You really don't want this thing to go too much, but here's the deal. So let's get into and cover the Japanese yen here. So not only we will cover the Japanese yen, what I want to do is show you the 10-year JGBs. So the couple things I want to talk about when it comes to this, I'll leave this on screen, is the JGB spiked. You can see this big spike up here. I'll bring it up full screen again. I just want to talk to you about it. The Bank of Japan has bought $14 trillion. They own 50%. Listen to this number. These are crazy numbers. They own 50% of the 10-year JGB. That's Japanese government bonds, right? They own 50%. You know, they've been known to buy 80% of all the ETFs in the country. The issue is they are the only central bank that's still on an easing while everybody else is trying to tighten, trying to downsize their balance sheet. They are doing the opposite. So you see this big spike we got up to 0.4, back at 0.25. They're trying to maintain 0.25 on this index. Let me go full screen so you can see that. Let me see if I can make these bars a little fatter so you can see this. So now you can see the big spike here. Not only did it go, this is the Fibonacci, the Wavetech Fibonacci projection tool. tool that was projecting it to go up to 0.427. The high yesterday, 0.432. So it went right to that fib target 2, got rejected, but this is what they're doing. What you're looking at along the lines. Let me just draw this so I want everybody's eye at the right place. This is 0.25. That's what they're trying to keep the yields at on the 10-year. That's their goal. And they had a big deal. I'm going to go into the yen here in a minute, and I think this is not going to work out for the best. Okay, so, but that is what they're trying to maintain going forward, is that 0.25 number. You can see we've pretty much been hanging out a little bit below, a little above, spiked way above, and this when they came in and intervened today to buy lots of these things. They bought a ton. I don't know if the number is that they bought 14 trillion yen worth today. Don't fact check me. I'm not sure about the numbers. I know they bought 14 trillion over this last period, maintaining this, especially the last 2 days. You see the 2 spikes. This is a serious effort for them to maintain. They have dug in hard on this. So let's go to the yen. So looking at the yen, this is the quarterly, but let's go to just a daily. It's down just a little bit. Yesterday's close was 136.59. We got up to 136.70, but we're down just a little bit. It's going to be interesting to see how this comes together. If you recall, just a few days ago, we printed down to 131 and just reversed from there. This pattern is setting up. I still think we're going to maintain above the 10-period moving average, 134.7. But if we print up above 137, then these targets that I talked about the other day, that is going to be the targets are for 141.7, 147, and 150. Now, I think 141 is realistic. If we print through 37, it's probably a pass, go, collect 200. You're going there, okay? You get to move on, and that's going to cause the Bank of Japan to probably have to sell some treasuries to raise more money to go back to this chart to be able to support that 0.25. They are getting at a point where they have to raise this money. Now, I don't know if somebody, my buddy Hugh Hendry made a comment on this. Somebody asked him, because I don't know if they follow me or not, that asked him on Twitter, but I was talking about if the Chinese had to sell, and they might maybe not have to sell, but it might be a place for them to raise money. They could really jack up these yields, and we could see a big surge in yields. And a couple times that I've talked to you folks about this, as we've seen the yields set like they are right now. If we went back to the 10-year, you could see what I'm talking about. It's basically setting at the higher end of the scale where we are, and all of a sudden we get these surges, and everything you thought technically, whatever, we might consolidate, that goes off the board, and everything comes and they just sell these bonds. So I still have the mark at 137, and it's a number I made up just for the record. I think that's the capitulation point. It might be 141, and then they spike the yen. If I go back over to the yen here real quick, the next level would be, way up here at 147. So we could just see a vertical move, and especially if they start to sell the treasuries. So let me just unpack this just for another second here, is what would happen if they sold treasuries, yields spike, the dollar is going to get stronger, that they can't win here. I talked to you folks about this a while back. They just, in the end, they can't win. And this, once you get so far into a trade like this, and I was referencing back in the Asian crisis back in the 90s, and when I first started in the markets in 1979 and early 80, the dollar was really strong, and you had all kinds of issues going on there because we had 17, 20% interest rates, right? So I'm just telling you that when the things that happened back in the early 80s, what happened during the Asian crisis, and what's likely to happen again will look similar in their action, is that they have dug in trying to save themselves. And in 1989, at the top of the Nikkei, when that happened, there was another dislocation of capital because and I know going back in 2020, we were talking about there's a video on YouTube by a professor, I can't think of his name right now, but it was called Princess of the Yen, not Princess, Princes of the Yen. Watch that video, because what's happening, we're kind of at the end of that 89. I thought we had more to go, but we're now with the inflation and some of the things that are happening, we might be closer to 1989 in the Nikkei than we are 1929 or any of these other things. There's a capitulation happening here from the standpoint of the type of scenarios that can emerge from this type of environment. Listen, no one knows what's going to happen, but if this prints 137 or above 140, it's a disaster. And they're going mainly because it's just like any of us. We put a trade on and we dig in, and we're willing to buy a trade, say, okay, I'm going to keep adding to my trade. Everybody's done one of these, maybe. I know I have, where you're buying down and you're like, okay, I know I'm right, and I keep buying and buying and buying. Well, then if it breaks from there, once you do that, you're screwed. You have no more money to buy. You can't average down anymore. And now to get back to even, it's terrible. And this is the same thing happens with sovereign governments. They get so deep into their ideology, and whatever they're trying to do right now, I believe is going to fail. And if I'm right, it's not going to be pretty for the rest of the planet. So I think I went on that riff long enough, but this is important to understand. And listen, it may not happen. I hope it doesn't, because if it does, it could spike yields substantially, and the Fed isn't going to be having to do much. The reality is, I think the Fed, I'm just kind of mixing everything together because it's relevant. I think the Fed right now is letting the marketplace try to decide where rates are going to be. They're not even doing much. And we already saw the big surge. The Fed's adjusting to the rates. And I've talked to you about the dog wagging the tail again. For years, the tail was wagging the dog, which was QE. Now, the markets are starting to drive the Fed. That's how it mostly worked most of the time. It's really just been since the Ben Bernanke helicopter Ben period of time that we saw the opposite with QE. We saw it with Grandma Yellen, and then we're seeing it with we'll call him Pinocchio Powell, right? Somebody came up with that name. I kind of like that, because these folks are lying, and they're hoping that their lies will convince us that nothing bad's going to happen. There's nothing to see here. These are not the droids you're looking for. They're trying to do a Jedi mind trick on us. I'm telling you right now, this is a scary moment. I'm hoping that the markets find some legs, but it looks to me this thing's set, not in stone, but it's set. And those of you know my nickname, Dr. Given, some of this stuff looks like a given to me, and we'll see what happens. Just everything I've talked about so far in tonight's stream, I just want to emphasize, is that what we're really seeing here is everything in sync for once, in a bad way. So we got all these angle of attack, all the indices are major downtrends. Everything's going down. Is the plunge support team going to show up and start buying stocks? Maybe. I mean, they've got money on the balance sheet. They could do that. But it could get scary enough that all of these central banks are going nuclear on the situation. There's no doubt that the Japanese have gone completely nuclear here. And they have decided that 125 line, I'll bring that chart back up again, that that 25 basis points on the 10-year JGB. They've decided, for whatever reason, that's the yield they want to have, and they're willing to go all in. So we'll see what the outcome is. I don't think it ends well. I know I'm kind of caught in a loop here. I'm trying to close it out. But the bottom line is I don't think it ends well, just because of there's so much at stake, and the bet's so big. When you get to 50% of a market, maybe they go 75. What happens when they run out? They're going to have to, at some stage, you're going to have to sell treasuries. I think I sunk my putt, so we'll move on from here. But please know this is still a very serious issue that's out there, and there's a lot at stake here, in my opinion. And I think rather than everybody talking about what the Fed's doing and inflation and all that, I think this is the most untalked about story that's really has the most potential impact on everything. All right, I'm done. Let's move on. Okay, so next we'll go through crude oil. Crude oil starting to crack right now, down 3.18%. Like I said, this is first time I've been on here for this year and talking about crude oil rolling over, and it looks like that's what's happening here. We're taking out the 10. This is the weekly. ppm 1 is still at 0.44. I've talked about this in the live room sometimes, but these ppms, when you're looking at the ppms, especially the longer term you have to move the decimal. It's really like a 0.04. You need a much bigger number to support the markets on these weekly moving averages from the angle of attack viewpoint. You need a higher angle of attack. It looks big, but you can see it rolling over. You can see it visually rolling over. That's what this is, rolling over. The next level on this chart that's probably going to be there is going to be coming close to 100. That's $6 away. That could be tomorrow. That could be very quickly. The main thing is, it's really about everything I've been talking about tonight, is that people, I think I saw a headline that more and more economists and companies are thinking in 2023 we're going to have a recession. No, we're having a recession right this second. By the time the metrics show it, that it's going to be way behind when it happened. It's already happened, and this is what you're starting to see in crude oil. We saw that last little hurrah a couple of weeks ago, and we basically retested that spike high that we had going back. We were unable to get through it, and for now we're going to set up probably a much bigger pattern from the standpoint of crude oil. So that's going to stabilize, maybe come down a little bit more. Maybe we'll see gas. I won't bring up some of the other elements. I know nat gas was under pressure. So all of a sudden everything, but it's because of recession. It's not because they have more oil. It's not because of any other fundamental issue. It's the concept is, and is starting to reveal itself, that we're in a full out recession right now. It's one of those things is, if you're sometimes in sports games, the other team's lost, but they don't know it yet. There's no way to come back. And that's kind of where we are now. We're looking at this scenario where everything's going to unwind. And once it gets to a certain point, like I said, going back to the database, tying together everything that I've been talking about tonight, is the recession is here. I was going to call tonight's video Recession, 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 because that's what's going on here. And that's why you're seeing they're starting to get some demand destruction going on. But it's more of the markets looking into that. There's still decent demand, where summer driving season, all that stuff. But in the reality is that bets are being put on the other side right now, or bets are being taken off from the standpoint of what happened in the oils and all that stuff. So if you were in oils, hopefully the bounce that happened yesterday was your last chance to probably get out, because I see stocks, the commodity, everything starting to roll over at this point. Let me take a quick look at the daily just so we can get a handle on that. As the dailies through 10/21/40, PPM's minus 1.25, 0.8, still positive on the 40, but we've rolled over on the daily. Everything, what was looking like it was going to support it, supported for 2 days. We've now lost that support. And, we could be heading for, probably really you have to look at the weekly charts, probably 100. I'm going to go back to weekly just for a second because I want to reference something. So the 100, yeah, we have a pivot at 93, and I'm still going to argue to a degree that as long as we stay over 95, ultimately there will be a point in time where maybe you can put these energy stocks back on. But if I'm right, we're in a recession, everything's rolling over at this level, then that's not what's going to happen. Okay, we're going to just see continued deterioration in the energy complex. And like I said, this is the only thing that worked. I saw somebody from the administration talking about, well, the underlying economy is still very strong. It is not, okay? Credit card debt is spiking. Why? Because everybody feels so good they're going to run up their debt? No, it's probably almost all gasoline. People are just trying to finance their way out of this. So there's a lot of signs of stressors coming out of the market. So we'll see what happens. I know I went on a lot tonight about quite a few things, but I think these are all important to understand from where we are right now. Like I said, we can stabilize here, get a short-term rally. I still think there's probably, from overall that the equity markets could have a decent third quarter. We'll see how it sets up, and I'll see if I maintain that as we finish off this quarter and come into next quarter. But this energy complex is telling us the real story, I think. Next market we'll cover is gold. Gold is, I talked about this cycle low that's coming in. We'll see if there's something that comes in. We're looking at some significant numbers. This is a weekly gold chart. So far, we've had a print low of 1827. 1827 is S1, basically 1826.60. So we printed down to S1. If we get through that, then S2 is going to be the key number in this pattern, 1810. I think we'll hold here. I like how PPM2 is set up. We still have a lot of downward pressure to burn off, so a couple more weeks to get that going from the standpoint of any continued configuration here that's positive. Okay, final market I'll cover tonight is Bitcoin. Sorry about that. I keep doing the same thing. Bitcoin still staying under its 200-week moving average. I think that's significant. That number is 22,413. High so far this week has been 21,688. And I know just about every exchange has a different number. I'm not sure where TradeStation's getting their numbers, but that is, this is where it's showing here from this standpoint. So we're looking at this 200-day probably being a significant number. We got to close last week under the 200. I said day, 200 week, 200. If we get another close coming into this coming Sunday, that will be further negative. PPMs are stabilizing, but the numbers on the PPMs are huge. 6.07, minus 6.07, minus 2.14, and minus 1.43. So those are substantial downward trends that are out there. We'll flip over to a daily for a second here. The other thing that's happening, we're getting this very narrowing market grid from that standpoint. Let me blow this up just so we can get a better view of this. This is so tight, it's hard to see. But you can see how it's narrowing in here. PPM's big numbers, minus 4.15, minus 1.48, 1.39. The 10-period moving average here is 22,222, which is right at the 200-week moving average. The 10-period down 4.16. There's less than a 10% probability to get above that number. We have somewhat stabilized after over the last several days, but I think there's still another leg down. There's a fib target number, 15,767 is still in the works. Let me get rid of this. Yeah, so there's two fib numbers out there that are still valid, and those are 15,767, 12,935. Those are valid numbers from that standpoint. So come back up. Okay, so that's going to do it. I just saw a comment in here. Someone's saying, put your money in credit unions. Credit unions are the absolute worst banking institution that's ever existed. They have the most risk. My brother and I have been trying for years, trying to figure out how to short those banks. They do the worst loans. They're terrible. They're terrible managers, and I would be very careful about that thought. I'm not sure where you hide, okay? But it's not credit unions. Credit unions are terribly run. Credit unions are like municipalities. They're just not. If you look at their lending privileges, lending process, especially on multifamily, they have just put all these banks at risk, and it's one of the weakest part of the banking system. So sorry, I don't mean to be rude, but I have a lot of background on the banking side, on the institutional side, and these are very scary places to hang out. Anyway, folks, thank you so much. I don't know who said that. I just happened to catch it. Yeah. So anyway, folks, this is it. Hit that like button. Subscribe, please. This is free stuff. So just that's all I get paid. I get a like, So, but anyway, those of you that have signed up for the indicators lately, fair amount of you since Saturday, make sure you go back and watch the Saturday's seminar that I did. Unfortunately, it died. My service and my software died right at the end of it. But I'm going to be doing day trading, trend following, and swing trading videos. That's all I'm going to focus on. And tomorrow at 1 p.m. Eastern time, we'll be in the live room, so I'll see everybody there, and we will see all you folks on YouTube tomorrow night. Thanks for watching. Really appreciate it. Have a great evening.